There's no sign of identity theft slowing down. And why should it? More than $29 billion were stolen from identity theft victims last year alone. To cybercriminals, it's a success story. To the rest of us, it's a wake-up call. Your personal info is in more places now than ever. And all that exposure can make it dangerously easy to steal your identity. LifeLock makes it easy to help protect yourself by monitoring your identity and alerting you to threats you could miss on your own. And if you do become a victim of identity theft, a U.S.-based LifeLock restoration specialist will be dedicated to your case and will work to fix it. Don't wait to get LifeLock identity theft protection. Join now and save up to 25% off your first year. Go to LifeLock.com/ACAST. That's LifeLock.com/ACAST to save 25% your first year. LifeLock. Identity theft protection starts here.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello and we're still in COVID-19 mode where I'm chatting with guests about the current situation as it happens. We're recording this at 7:30am Australian Eastern Time on Wednesday, April 15, and I'm joined by stockbroker Evan McQuire, who is our guest on the second episode ever of Shares for Beginners. G'day, Evan.
G'day, Phil. How you doing?
Not too bad. It was only a couple of weeks ago that markets were being heavily sold off, but there's an enormous turnaround going on at the moment. It's said that we're in a bull and a bear market at the same time. How are you seeing things?
It's an interesting situation because the impact of this in terms of the global economy is, in my mind, will be fairly significant. And on the other side of it, you've got central banks and also governments throwing everything at it. It just seems to be this double-edged sort of, okay, well, it's going to be bad, but you've also got a lot of activity by central banks, in particular the Fed and, even the Reserve Bank here in Australia throwing everything at it. But having said that, I'm very sceptical of the current rally that we've seen from the lows.
So you're saying governments are throwing everything they can at this situation. We've got the JobKeeper package here in Australia, and in the US they're even printing money, I believe, in some of these cases. How's that actually work?
Well, the way it works is that basically central banks, the Fed or the Reserve Bank, will buy government bonds. The whole purpose is to keep interest rates down, and also to basically grease the economy, if you will.
And when they're buying bonds are issued by governments, aren't they, to fund their debt? So aren't they actually borrowing from themselves?
In a way, yes. And I mean, we don't want to get too technical with the mechanics of what they do, but again, it all comes down to them issuing. The governments always issue bonds, and there's all different types of bonds that are issued, but again, the whole purpose of doing what they're doing is to keep the economy and to keep the banking system liquid. That's what it's all about.
Does this artificially inflate markets? Is this one of the reasons why markets are moving so strongly at the moment?
Yes and no. I think, look, when you're in a very low interest rate environments like we are and we have been for some time, and that's, from what I can see, that's not going to change anytime soon, people need to put money to work. So they're more likely to invest in the stock market or perhaps property. But if we look at the stock market, there's a couple of things where, again, people need to deploy money and to be able to get a return on their money because they're not getting what they want to get or can get in, say, a term deposit or in a bank account. And there's always, if you're getting 3% dividend from a stock, it's a lot better than what you're going to get in a term deposit. That's why I think people are flocking to equity markets at the moment. And we saw this towards the end of last year, this whole thing of FOMO, fear of missing out, where people want to be able to jump on board, get set, enjoy the upward movement of the market. But that can obviously change fairly quickly, as we've seen in the last few weeks. But with the turnaround that we've got at the moment, that we've had in the last couple of weeks, I think a lot of that's based on, look, perhaps the market was oversold, but it could also be that, again, central banks and governments are doing everything they can to support economies. People think, well, the worst is probably over, talk about reopening economies and all this kind of stuff. But again, I'm fairly sceptical about that at this point in time.
Well, on that particular point, I'll just quote to you. This is the chief economist from the IMF who came out overnight and said, "This is a truly global crisis as no country is spared. This makes the Great Lockdown the worst recession since the Great Depression and far worse than the global financial crisis." Are we being lulled into a false sense of complacency here?
I think so. Okay, it was a big sell-off. All right, fair enough. And obviously we've seen a bit of a fairly decent turnaround here. But if you ask me, could I see the market potentially retesting its lows in the coming months? Absolutely. I just think that people need to be very careful here. And once we start getting into reporting season, we'll start to really see some of the impacts of the coronavirus in terms of how it's affecting companies' profits.
So that's in August, isn't it? The next reporting season?
Oh yeah, well we've got this. The US is going to be coming up pretty soon, and then us locally. That's correct.
Yeah,
around July, August. So yeah, so look again. I think we'll start to see data come out of the US, and then we'll see what the impact's going to be on the local companies. But if we start to, so this is the thing. Once you start to see, for example, so the big banks start reporting and things aren't looking so good, then potentially you'll see a lot of these stocks get re-rated. And also, if they cut dividends, then that's even more interesting because, a lot of Australian investors have been spoiled in some ways around the dividend and dividend yields they've been getting from a lot of companies, in particular the banks. If that continues, it remains to be seen. But again, I just think the markets are getting ahead of themselves a little bit here, and I still think there's going to be a bit of volatility to come.
What do you think the economic impact is going to be? What's your view on that?
It's difficult to know. Obviously, this is something that I haven't seen in my lifetime, and I don't think you have. And this is history in the making, and it's just difficult to see what. Obviously we know that at the moment, around the world we've got, like in Australia, for example, we've got, in the States, we've got gyms that are shut, pubs are shut, restaurants are shut. They might be doing, takeaway meal here and there, but that's fairly significant. And I just don't know what it's going to look like once this is all over. We've still got this JobKeeper package that'll start to get, I believe the payments will start to get rolled out in May. But in the meantime, people are either tapping savings or doing whatever they've got to do to stay alive. It's a big machine, and it's just difficult right now to see what parts of the machine are really broken and what parts of the machine are okay. And this goes back to why central banks and governments are throwing everything at it. But I'm still very pessimistic, and I still think there's going to be more bad news coming.
Yeah, because I think it's like 50% of businesses in Australia are small businesses, and they're the ones that are really copping it at the moment, aren't they?
Absolutely. Look, my understanding of this whole thing around essential parts of the economy. So obviously, chemists are still open. You can go to buy your groceries, and you can still get petrol in your car. And they've kept, for now, my understanding is they've kept the building and construction industry moving, because that's obviously a fairly big chunk of the economy. Retailers, obviously, if you're a retailer, it hurts. Perhaps the online side of things is okay, but in terms of bricks and mortar, the big box stuff, that's just getting belted.
And not only is it getting belted, but that would have a flow-on effect to the property sector as well, the commercial property sector, wouldn't it?
Yeah, well, that's right. And if you saw, Premier Investments came out a couple of weeks ago saying they're not going to pay any more rent, and you've seen the government's come out with a proposal around reducing. If you've had a 30% drop in rev, then the landlord should be meeting you with a 30% haircut on the rent.
Yeah.
But then you start looking at, well, okay, how does that work in terms of financing or funding that's been provided by the banks? And it just creates this situation that, in my mind, is quite murky and difficult to really pull apart and work out exactly what the medium to longer term impacts are going to be.
Yeah, because I think the government was trying to put in place what they call like a suspended animation, a hibernation period, and then we'll just sort of pop out of it again. But turning it on is not going to be that easy, is it?
No, and I think the unknown right now is how long is this going to be? Because let's say hypothetically, well, the Prime Minister comes out and says, well, okay, we could start reopening things up, let's say in 2 months' time, hypothetically. And you go, okay. And then within a month, we get a flare-up of viruses again. Oh, okay, we've got to shut everything down. It's difficult to really get a good grasp on and to be able to forecast exactly what's going to happen. And again, this is why central banks and governments pretty much globally are doing everything they can to keep this thing moving, because if you can't have a system where people have got some basic money or some kind of safety net, if you will, then you start talking about, well, if people don't have any money, then you start talking about civil unrest and all this kind of stuff. And I think this is the thing that a lot of people don't want to see happen.
What's your thoughts on iron ore? It was iron ore that basically got us through the global financial crisis pretty much untouched. Demand is still strong for iron ore, and BHP and Rio and all of those companies, they're running full steam ahead at the moment. Do you think that's going to have some sort of cushioning effect?
It won't be the same as what we went through in terms of the GFC. See, one of the reasons why Australia got through the GFC, in my opinion, was more luck than anything else. China, at that point in time, was doing a huge amount of infrastructure work, but there does seem to be demand at the moment, but I don't believe we're going to see the same kind of demand because a lot of the stuff's been built. They're trying to change the way that their economy works. It becomes more of a internally based
consumer economy, isn't it?
Yeah, consumer economy, right? So the other thing that could happen too is where, for example, President Trump comes out and says, we're going to do $2 trillion worth of infrastructure. That could be very supportive of iron ore. You've seen little announcements like this from the South Australia government, came out with something a few weeks ago. I mean, in New South Wales and Victoria, there's been a lot of infrastructure work over the past few years. I don't know how much more they can do. I'm very sceptical. I'm sceptical about the demand for iron ore. I just don't think it's going to be the same as what it was during the GFC. I don't think we're going to see that. However, as I said before, there could very well be some kind of fiscal programs that governments come out with saying we're going to do a $500 billion worth of infrastructure here and there and wherever else, and that helps prop things up.
You chat with a lot of other brokers and people in the industry. Are you having any interesting conversations at the moment? What's the word on the street?
I don't know. I think a lot of people at the moment are happy that there has been a bit of a turnaround. But again, I just sense perhaps a bit of apprehension and maybe a little bit of surprise as to how quickly this thing's come off and then turn around. The volatility, I think, is a bit of a talking point. But I think also, again, probably a bit of skepticism and trying to work out, are we through this thing, or are we going to see a retest of the lows? I'm more of a believer that we're going to see more volatility, and I wouldn't be surprised if we come off again. But it's too early to tell what the damage is going to be, and if the efforts that we've seen thus far will be enough, or if more needs to be done, it's just difficult to tell.
Have you ever Googled your own name? Prepare for a shock, because your personal info, including addresses and phone numbers, is all out there. It's all harvested by data brokers and sold legally. Aura is a personal digital security service that scans the internet for your sensitive information and provides a full suite of privacy-enhancing tools. For a limited time, Aura is offering listeners a 14-day free trial at aura.com/safety. That's AURA.com/safety to learn more and activate the 14-day trial period.
Okay, well, let's go on to some listener questions. I'm just going to simplify them a little bit because people are asking a lot of things. And before we do that, actually, I just wanted to point out that I've started up a chat group on the Shares for Beginners Facebook page, and your broking firm, MFAM, has also got a chat room as well on Facebook, doesn't it?
Yeah, MF and Co Asset Management. We've got a chat group there.
Yeah, it's a very active chat group, and so a lot of these questions can be directed to that room or to the Shares for Beginners room, and we'll deal with them. But I've got some questions here from Luke from Melbourne, and I wanted to thank him very much for all these kind words that he said about the podcast. I think he's listened to every episode twice now. And, well, first of all, he was asking about record keeping, and is there anything else apart from ShareSite? Now, personally, I used for a long time a software package called Microsoft Money, which is a free software that used to be provided as part of Microsoft Office. It hasn't been supported by Microsoft since about the late 2000s, but it's still available and it still works and gives you some basic account keeping for share trading. However, I would say that ShareSite has got many more features, including benchmarking and a whole bunch of tools that you can use for tracking and making sure that you're making correct investing decisions. And I'll just have a little plug for the affiliate marketing program that I'm running with that. And if you go to sharesite.com/shares for beginners, you can get 2 months free on a premium subscription. And then he also asked about dividends, about how they get paid. Do they go into a linked bank account, and how can you reinvest with it without incurring brokerage fees?
If the company offers a dividend reinvestment plan, then all you have to do is to nominate with the share registry to have your dividends reinvested. And that's not hard. That's just contacting the share registry and nominating for that to occur if it's offered by the company.
Yep.
If it isn't offered by the company, then you'll have a nominated bank account that the dividends will be paid into. In terms of, I will say one thing though, in terms of if people are curious about what they need to keep for tax purposes, the best thing to do is keep your trade confirmations or your contract notes, and also provide your accountant with, say, your bank statement for the year, and that should be sufficient.
And your dividends, any dividend records, yeah. That's
exactly right. And a lot of that's not hard to put together. You can get a lot of information online, share registry, if you've got an online broking account, or if you need your broker like us to provide that kind of information, that's not difficult at all.
So the other question we've got from Jing is about capital raisings. What do they mean for the everyday investor? Because we're actually going into a time now where a lot of companies are doing a lot of capital raisings. What does it mean if you already hold shares in that company? And what does it mean if you don't already hold shares, but we're thinking of buying that stock for a capital raising?
Well, generally when there's a capital raising, there's a few ways companies can go about doing it. They can do it either via an institutional placement. So that's where retail investors won't get a look.
It's only the big institutional investors that are going to get a bite of that cherry.
Correct.
Yeah.
That's where, the company wants to, XYZ wants to raise $200 million via institutional placement. So they basically do that, issue stock, raise capital, done. Usually it's offered to existing shareholders or it's done via institutional placement.
It's for bolstering their capital, isn't it? It's for making their balance sheet stronger, isn't it?
Correct. If you go back to the simplest reason why there is a stock market, well, there's two reasons why there's a stock market. One, for people to invest their money. Two, for companies to raise capital. That's essentially what it's about. So, and obviously, you're an investor, then you're privy to the good times and the bad times of that particular company. Sometimes it can be good and then sometimes it can be terrible. That's why companies raise money, is so they can bolster their balance sheets and they can use that capital as to keep the business moving or to do acquisitions or whatever the company sees fit.
But isn't there a negative aspect to that in that once they've raised the capital, they're doing it by issuing more shares, and that means the value of each share is reduced? Is that correct?
Well, it depends on the company. I mean, if you're talking if you're talking a top 200 company, then yes, but not as bad as if it's a small cap where there's 500 million shares on issue, then they go and raise another 10 million shares, and now there's 700 million shares on issue. It becomes like confetti. So
the value of each individual share is reduced because it's just the number of shares.
Yeah, it gets diluted.
Yeah, it's just the market capitalisation divided by the number of shares, isn't it?
Shares on issue. Mm-hmm. Correct.
Yeah.
It just depends on how much they're raising and how much scrip or stock's going to get issued.
Mm-hmm. Yeah.
But you tend to see that heavy dilution happen more at the smaller end of town.
Okay, well, I think it's about time we all got started on looking at what's going to happen with today's markets. What are your thoughts about today's market?
Look, SPY was up 10. We did a lot of our move yesterday with US futures. We may follow through. I don't think we're going to be up 2 or 3% today because, again, we had a good move yesterday. And also, we were doing a little bit of catch-up over the Easter break. So given that the SPY is up 10, I think we'll be up, but I don't think we're going to be up 2 or 3%. As I speak, S&P futures are off the pace a little bit right now, but we'll see how that goes.
Yeah, because at the moment, we really seem to be tracking the US market very closely.
I mean, the way I tend to operate is that I monitor SPY futures and S&P futures pretty much. I have that running all day. And yeah, if you're seeing some decent moves in the US market, we're going to follow suit generally. And another interesting thing too is that the Aussie dollar, Aussie US, the Aussie dollar's at 64.42 at the moment. It's had a pretty good run up over the past few days, and equity markets. So it seems to be a little bit of a disconnect there in my view, because what usually happens if you got the Aussie dollar coming off, and that will help some of the companies there that are getting offshore earnings, but during the day, my perception is that we move pretty closely with what's going on with US futures. So, if US futures were to come off between now and when their local market opens, then you would see a muted start for us. But again, the SPY was up 10 points. I'm not expecting for us to jump out of the gates here, in terms of being up another 100 points or anything like that. And again, we did do a bit of catch-up yesterday.
Yeah. Oh, well, interesting times, Evan. So thank you very much for joining me today and having a chat about this.
No problem, Phil. Thanks very much for having me.
Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation. Thanks to Christopher Soulos for music production with that special Greekalicious flavour. Remember, music always flows, even when the money won't.
Did you know that personal information, like addresses and phone numbers, is collected and sold by data brokers across the internet? Fortunately, Aura steps in, scanning the web, sending you alerts, and requesting the removal of your info when found. Get a 14-day free trial of Aura's full toolkit, including ID theft protection, parental controls, and more at aura.com/safety. That's AURA.com/safety.